My name is Patience Maina. I'm a Deputy Director in the Insurance Supervision Department at the BMA. This is not my typical voice. I do have a well-timed sore throat, just when I have to talk to you guys. But hopefully I'll be able to power through it, and I do have my colleagues with me. Webster, who is next to me, is an Assistant Director in Insurance Supervision as well, and both of us work on the long-term team, or what's commonly known here as life and annuity. And then we have Victor Akin, who is a consultant and an actuary as well in our department. Thanks again for joining us, and thanks to the NIC for having us. So what we are hoping to do today is really give you a high-level understanding of the Bermuda reinsurance market as well as our supervision. I'm totally recognizing that we only have 50 minutes, so it will be high-level, but we'll try and touch on the very key aspects which we think are points of interest. But we are very happy to respond to questions even after this, and even set up other sessions if needed to do deep dives. So today we'll be doing an overview of the regime. I'll also take you through some of our key supervisory processes, and then Victor will take over and talk to you about our capital and solvency framework and how some of the aspects there compare with the US regime. And then finally, we'll have a brief session on some of the regulatory and supervisory enhancements that we are looking at. In terms of how we look at our insurers, we have them categorized into different businesses, and we have different license systems. So unlike the US, where it's one license, in Bermuda we do have a multi-license system. And the idea behind this is because our supervision is risk-based, and therefore what we are looking to do is to categorize the entities and supervise them depending on their size as well as the nature of business. The first category there is captives, which are the oldest entities in Bermuda. They have been in existence since the 1960s. And captives essentially reinsure own risk. Then we have commercial insurers, and these are the ones that most of you would be familiar with. So the large entities that we have, quoted companies, would fall under these two categories, and they would be split between general business and long-term, and again, long-term here refers to life and annuity. The third category is the special purpose and collateralized insurers. These are typically found on the P&C side. I think on the long-term side, we only have one SPI. But these carry special purpose vehicles such as cat bonds and other fully funded vehicles that are funded, that are collateralized to the limit. We have the intermediaries category. This is for the insurance marketplace players, so be it agents, brokers, managers, and such. And finally, we have our innovative insurers class, which we introduced 6 years ago. And essentially, this one is for upcoming business models, particularly in the tech space. So you'd find some fintechs, entities, and other digital platforms coming through here. And they also do utilize the sandbox, which is a testing environment that we provide for 6 to 12 months, and that's guarded, that has certain tailored guardrails. And then once the entities get out of the sandbox, then they move to the regular classes of insurance. Maybe just spending a little bit more time here to provide clarity on what we mean when we talk about captives, because I realize captives have a different definition here in the US. So captives for us, again, they refer to reinsurers that cover risks, that's own risk. So this would, for example, be a large manufacturer in the US that has thousands of employees. They have quite a bit of workers' comp, and as opposed to going to the traditional reinsurance market, they would form, say, a class 1 captive in Bermuda and reinsure that risk to that class 1. This is quite different from reinsurers who cover affiliates. For reinsurers who cover affiliates, these are commercial entities that cover related business, but the underlying business is unrelated. So unlike captives that cover their own, affiliates cover underlying business that's unrelated. And very important to note that those are subject to the same regulatory requirements as all the other commercial insurers that I spoke about on the previous slide. And then finally, we have sidecars. These are commercial entities whose main focus is generating and deploying third-party capital. So if you have a reinsurer who's looking for additional capacity, they would come into the market, create a commercial entity, get capital into that commercial entity, and then seed business into it. Again, sidecars face the same amount of regulation as other commercial entities. They do not have, any special treatment or anything. Again, the Bermuda market is largely a reinsurance market, both on the general business side and on the life side. It's a very well diversified market. We've been in existence for the last several decades. We're diversified both on a geographical basis as well as on a lines of business basis. Our largest market does remain the US, so a very important market for us, and this is reflected in a press release that I think we'll be issuing later this week, where we analyze the amount of claims that we've paid the last 8 years. So our reinsurers have paid 1.1 trillion in claims, and 700 billion of those have been to US policyholders. So again, quite an important market in terms of providing capacity to the US. And we do expect more recently to pay about 10 billion for the California wildfires. The investment portfolio for our entities is high quality, so close to 80% is fixed income investment grade assets. The entities also have strong solvency positions at close to 260%, with the minimum being 100%. And we also do have adequate liquidity in the market. As a lot of you know, and probably part of the reason we are here is that we are also an NIC reciprocal and qualified jurisdiction. I won't spend too much time on this. It's just talking about what I've already spoken about in terms of diversification and where our business comes from for both lines of business. I'll spend a bit of time on this one, and this is because we do get quite some questions on this, and the question really is, why Bermuda? Why is business coming to Bermuda? And to be able to answer that question, you do need to get an understanding of some fundamental elements of the Bermuda market. The first one being that, again, Bermuda is predominantly a reinsurance market. So unlike the US, which is a mix and probably predominantly a primary market, Bermuda is a reinsurance market, and reinsurers typically focus on one, risk diversification, and two, raising capital, whereas primary insurers would be involved in operations and claims and so on. So given this is primarily a reinsurance market, it is a business-to-business market. And Bermuda has created a platform such that entities are able to come in and raise capital in an efficient and transparent way, and also with speed to market. And on the other side, as I mentioned, the jurisdiction is also very well diversified from a product as well as geographical perspective. So then we have access to capital with investors bringing the capital, and we have our reinsurers providing the risk diversification, and that's what creates one of the key elements of the Bermuda market. A second aspect, as I have mentioned, we've been in existence for several decades, and what has happened is that then an ecosystem has been created of professionals, of professional firms, be it actuaries, underwriters, accountants, lawyers, and so on. Therefore, we are able to do complex transactions and in a fast manner and with individuals who understand what they're doing. Therefore, insurers do find it easy to come in and, plug and play, so to speak, as opposed to going and setting up in a totally different place that does not have the same depth of expertise, of concentrated expertise that Bermuda does have. The third aspect, and I did touch on it when I spoke of the sandbox and the innovative insurers, is that we are at the forefront in terms of facilitating innovation. And this is responsible innovation, keeping in mind that obviously our key goal is policyholder protection. But then we are able to be pragmatic, and entities are able to come to us and test various business models, while again considering what's safe for the policyholders. Then the final point there, and again, this is also an important one, is that essentially our framework, which Victor is going to go through, is an economic-based framework, which means the liabilities and the assets are valued on a market-consistent basis, removing the volatility and noise from the balance sheet, which then gives some certainty to the companies as they're operating in Bermuda. I'll now speak on our supervisory processes, a lot of which would look like some of the regulators that we have here in the US and elsewhere. The first thing is that we receive various filings. Some of these filings are annual, others are quarterly, others are tailored depending on the entities. Some of the key things we receive are audited financial statements, what we call the CSR return. We also receive an OSA on an annual basis, and it's what we're referring to there as a CISA. And more recently, we now require our commercial entities to submit recovery plans on an annual basis, which we will be reviewing and providing feedback on. Once we get all these submissions, we do an initial compliance review and get back to the entities identifying where the gaps are and what additional information they need to submit. And then following that, we also do a preliminary off-site review. So this one is more detailed. We're looking at various risk areas, which I'll go through on the next slide. And out of that, we then come up with a supervisory plan, identifying where the risk areas are and where we're going to focus. And this could result in various activities such as on-site reviews, meetings with the registrants, and even supervisory colleges where we interact with other supervisors also do fall into our supervisory plan execution. And this is an iterative cycle. So, based on the activities we conduct and the information we get, then that feeds into the next cycle and the information that we will be looking to obtain. Our entity framework is very, very detailed. That busy slide is essentially to show you that we pretty much look at everything. So be it the company strategy, their corporate governance, the business model, the operational resilience, risk management, and so on. And after looking at all these areas, we risk rate them. You'll see a legend up there where we risk rate these areas, starting from low risk all the way to the high risk. And this one informs our overall risk profile for the companies or the group, so whether they're high risk or low risk, as well as our outlook, which ranges from stable, marginal, all the way to watch, and the knowledge heat map, which essentially reflects how well we think we understand the business and where the gaps are and what we should be looking at. So again, a very comprehensive review, and it feeds into the cycle that I spoke about earlier. The OSAs would be quite familiar to a lot of you, so similar to you, regulators in the US, we do require our entities to submit OSA. We get the OSA on an annual basis, we conduct a review, and we provide feedback to the entities. And we look at 4 main areas, which is the insurer financial strength, including how they are performing under various stresses. We also look at their foreseeable material risks and their mitigations. We look at the OSA use test and how the OSA is integrated into the business. And finally, we do look at the risk aggregation and essentially just the reasonableness of the OSA target capital. On-site reviews, this would be similar to what's called financial examinations here. And again, these are generated as part of the supervisory plan tasks that I spoke about. And they're done in 3 stages. First would be the planning, where we inform the company and notify them of the areas that we will be looking at. But more importantly, we do have an internal committee called the On-Site Review Committee that, looks at the quality of the on-sites that we intend to do and gives us feedback on that. The field work typically involves several weeks of meetings with management and other stakeholders, as well as some desktop review. And following that, we generate a conclusion memo as well as an on-site report with our findings and recommendations and timelines, which we then discuss with management after we've gotten feedback again from our on-site review committee. And following that, obviously the companies execute on what has been recommended and we follow up. This speaks on the PNC side. These are legacy transactions or run-off business whereby an insurer is looking to offload their business and essentially stop writing it. We do have quite an active legacy segment in Bermuda, and all legacy transactions that come through must be approved by the BMA. As part of our approval, we look through what liabilities are being acquired, the nature of collateral, as well as the impact on the capital and what's required essentially for these liabilities. Very, very importantly, we engage with cedant regulators as part of the approval process, and we do take on any feedback that comes out of that, and then we perform ongoing review of this business on a quarterly basis. Beneficial controller changes. This one we have a dedicated vetting system, so when there are changes to directors, officers, beneficial owners or shareholders, this team vets these individuals or entities through this dedicated system and then passes along their findings to supervisors, who then take on various considerations such as the risk profile of the insurer, the extent of influence of the individuals who are coming in, the objectives or motives, how this is going to change the financial condition and solvency of the entity. And then following that, we give a no objection or an objection as the case may be if we have an issue. Group supervision is quite an important one, similar to here in the US. We do think it's a core pillar of supervision, and it contributes to sound insurance markets and policyholder protection. We are group supervisor of various groups in PNC as well as on the long-term side, and also we participate in a number of colleges here in the US as well as in Europe and in Asia. And we consider this to be quite critical because, again, very important to be able to coordinate as regulators and to get, just a holistic view of the risks across the groups. We are amending our legislation, and the big amendment that we are making is that now for entities that have a holding company in Bermuda, this will then come under the scope of our group supervision. Before we used to use what was called designated insurer. Now in addition, we are using this holding company criteria. Similar to what we've done in the past, obviously we would first discuss with other regulators and make sure that indeed we are the most suitable group supervisor for these entities. The quasi-group supervision is an internal setup that we have to supervise related companies that have common shareholding, so that then we understand, just the footprint and the influence of these entities, and we make sure that we are looking at any possible contagion risk. This might be my final slide before I hand over to Victor. It's in relation to the reciprocal jurisdiction status. And essentially what this does is allow non-US jurisdictions, such as ourselves, the reinsurers in our jurisdictions, to offer reinsurance to your US entities without the need to provide collateral. There is a process around this, and on the BMA side, we issue a certificate of compliance, which confirms that essentially these reinsurers are meeting the required 250 million capital and surplus threshold. We also do confirm that they're in good standing at the BMA. We conduct additional reviews and collaborate with state regulators, but then more importantly, this process is repeated on an annual basis just to ensure that there is ongoing compliance. And yes, I did have one last slide, and this one is in relation to public disclosures. We require our entities to submit audited financial statements as well as declaration of compliance. These are published on our website and are accessible to anyone who wants to take a look. But we also do require them to prepare a financial condition report, which they publish on their website. We are working on some enhancements that will be effective from this year, and essentially these enhancements are for disclosures around assets, so that then we'll be getting granular information on assets similar to what the NAIC requirements are. But in addition to that, we will also be getting the same amount of information on the liability side, because we believe it's very important from an asset liability matching perspective for us to be able to see both the asset side and the liability side. And this information will again be readily available. That's it for my sections. I'll hand over to Victor to take you through the last two. Thank you.
Thanks, Patience. So I'm starting off with this rather busy slide, but it's really important to go through it, so I'll take it slowly. The best way to look at this slide is starting from the middle, and both frameworks, U.S. and Bermuda, have some concept of assets. As you look at this slide, don't be too bothered by the sizing. So, the assets in a Bermuda framework versus assets in a U.S. framework will be valued differently. One might be book value and the other market value. But the point of this slide is just to really kind of show components of the solvency framework and how they're similar. As you move out from the assets, you'll see on the left, you'll see the U.S. statutory reserves are the main liability, and then on the right side, Bermuda has its own words around liabilities as well, called best estimate liability and risk margin. So, and those together compose the technical provisions, which is the term that matches statutory reserves. And then the assets in excess of the liabilities are capital and surplus. And then now moving out to the outer edge of this slide, talks about the capital requirements. So on the U.S. side, you see the RBC framework, where there's a calculation of risk-based capital based off of the risk profile of the company, the liabilities and the assets, and then you take the capital and surplus and divide it by this risk-based capital, and you get these ratios. And certain ratios trigger different actions, company action level, authorized control level, and you guys know that well. Similarly, on the Bermuda side, there's a enhanced capital requirement. That's the Bermuda version of RBC. And similarly, you calculate ratios. And similarly, the calculation is based off of the risk profile, the assets and liabilities of the company. And I think the colors of the slides is meant to kind of show you some similar, action levels. So if you have the enhanced capital requirement, below 100%, that's similar to, triggering the authorized control level. There's a target level that's at about 120%. That's similar to the company action level. And then obviously all companies hold additional capital above that. They have, their target capital levels that they've set. Diving into the reserves versus the technical provisions. So as I mentioned before on the previous slide, the technical provisions is composed of two parts: the best estimate liability and the risk margin. Under the Bermuda's economic framework, the assets and liabilities are on a consistent economic basis. The statement on the U.S., the statutory reserves are formulaic, but they're also principle-based with guardrails, and then it's overlaid with cash flow testing, asset adequacy. So there's a lot of differences between the frameworks, but there are a lot of similarities. And then so the value differences you see are related to the methodology difference and the assumption differences in the two frameworks. So digging into the best estimate liability, that's really a discounted cash flow calculation. One notable difference is the expenses are included in that, and for some of the long-tailed liabilities, the present value of expenses can be a significant item. So in the U.S. stat reserves, those expenses are generally not included, but in the cash flow testing, they are. So this is more similar to a cash flow testing exercise where you're looking at the total expenses of the company and reflecting those into the liabilities and seeing if the assets are appropriate for those liabilities. There's best estimate assumptions are used, and those are set by the company but scrutinized by the BMA. There's two different discounting methods that companies use: the standard approach, which doesn't require prior approval, and the scenario-based approach, which does require a lot of effort and submissions to get approval for that. And that approach is very similar to cash flow testing in the U.S., asset adequacy testing, where you're looking at projecting out the liabilities, projecting out reinvestments, the assets, and looking at different changes in interest rates, and seeing how and dynamically modeling that, and seeing how the company performs under those circumstances. And I should note, one requirement of the scenario-based approach is that your assets and liabilities are well matched. So as the companies do these 9 scenarios, what you often see is the valuation is very similar. There's not a lot of big spread where under a rapidly rising interest rate environment, the reserve will be much higher than under the base scenario, for example. So generally they're pretty well matched, but the worst scenario will determine the BEL, the best estimate liability. And as I mentioned earlier, there's a rigorous process around using the SBA, including submitting your assets. The BMA has a strong team of asset specialists who review and approve the assets and derivatives used in the SBA. The last statement talks about that as well. And then there are some limits and guardrails in the use of the SBA, including spread capping, which is, I think, similar to asset adequacy testing. So the risk margin, so just to kind of step back, you know, I come from a kind of a U.S. Environment, and these risk margin term is kind of been new to me, but I've learned over the last 2 years at least what the calculation is. I think it comes more from the European world, but it ensures that it works similar to, I would say, provision for adverse deviation in the asset adequacy test, where it's just another kind of add-on to the liability that adds to the reserve, if you will. And technically, it is the companies will project out their operational risk charge, their credit risk charge, and insurance risk charge over the life of the liabilities. They'll apply a 6% cost of capital on that capital held throughout that projection, and then they'll discount that cost of capital at a risk-free rate to the valuation rate. So then again, for some of these long-tailed liabilities that have a lot of insurance risk, you know, that could be a significant component of the technical provisions. This slide talks about I would say, the regulatory liquidity risk stress test that the BMA requires. So there's a liquidity coverage ratio that's calculated on a stress scenario. The stresses are defined. You know, mass lapse is a big part of that. And then with assets, you know, they're assigned to different categories, and then those categories have different levels of liquidity, and that's assessed or that's haircuts are applied to reflect that, and then there's a ratio calculated. So this is a useful tool to see this LCR published over time as companies submit it. But I would say, in addition to this kind of regulatory liquidity ratio, companies are required to have their own liquidity risk framework, and I think as you look at companies, that's the more important thing, is how do they view liquidity risk, and how do they monitor and measure that. So I would say this is a guardrail, and it's a useful metric, but I think as we dive into companies and try to understand them and make sure that they're solid and safe, looking at their own processes around liquidity risk management is what I find valuable. Similarly, there's a liquidity risk stress test on the P&C sector, and I won't go into any details here unless Patience wants to dive into something on that. Yeah, now we're going to go into regulatory and supervisory enhancements that have been made recently. And I don't know, Patience, you want to do this slide, and then I'll do the...
Thank you, Victor. Thank you, Patience. So some of you might be aware of this from the discussions that we've had in supervisory colleges, that in 2014, the BMA introduced a number of changes, or what we call enhancements, to our regulatory framework. And these enhancements were mainly targeted at the solvency and capital return, which Patience spoke about earlier, which is the Bermuda solvency capital requirement. So there's some changes that we introduced. So, for example, previously we didn't have an explicit capital charge calculation for expense risk and lapse risk. and we made enhancements to our regime to make sure that we reflect those capital charges. But on top of that, we also made some changes to our man-made catastrophe module, as you can see on screen. The other element which Victor touched on when he was talking about the scenario-based approach were the changes that we made to the calculation of technical provisions, just to make sure that we have more guardrails around the use of the scenario-based approach and the requirement for approval and requirement for approval of certain assets which we deemed to be too risky and require a bit of scrutiny before they can be adopted. Then the other element as well was the introduction of the transaction approval process, which Patience has touched on previously, the liquidity risk management, which Victor has spoken about. And of course, we did introduce some new recovery planning rules. So these came into effect this year in 2025, but they were introduced in 2024. So certain companies have been identified based on their size and the risk that they pose. And these companies are required to submit recovery plans on an annual basis. And these recovery plans are subject to rigorous review by the BMA. Going forward, in terms of the enhancements that we have in the pipeline, we have published a consultation paper on enhanced group supervision, which Patience touched on, so I won't go into that. Separately, we have a consultation paper that have gone out on the public disclosure of assets and liabilities. So we are moving ahead with that work stream with the implementation date of 31 December 2025 still being the target. And of course, we have another consultation paper that we have published on operational resilience and outsourcing. Colleagues are free to of course, go on our website and take a look at some of these elements. Then there is work that is going on regarding the enhancements to board and senior management accountability. So we are looking at the corporate governance structures and trying to bring in a bit of enhancements in that space. So we expect that the consultation paper will be out sometime in Q4 of 2025 with the changes being implemented in the following year. So yeah, I'll pause here and pass it back to Victor.
So yeah, one of the more recent regulatory changes has been the requirement that block transactions receive prior approval from the BMA before they're executed, and that's been going on since beginning of 2023, and that's probably part of the reason why I was brought in to help the BMA to review a lot of transactions, a lot of the U.S.-based transactions. But I've also involved with some of the Asian transactions now. So if you maybe start from the bottom of this slide, you'll see the requirements or some of the requirements that are that the companies have to provide when they submit an application. So why are they doing the transaction? What's the structure? What are the products? What's the reserves for each type of product? What's the risks that are in that? Where's the money coming from? How's the transaction funded? What are the fees? What's the assets that are part of the transaction? And then maybe there might be a rebalancing after the transaction that's envisioned. So, and then there's also a total asset requirement attribution, which is a way to look at, what are the, I look at it like, what's the market value of the assets that are backing these liabilities before the transaction? And then once it's moved over to the reinsurance company, what is the market value of assets that are backing the liabilities after the transaction? And a total asset requirement, I mean, the reserves plus the required capital plus the target capital. So it's really what's your target capitalization? before and after the transaction. And so it's useful looking at those differences and understanding the calculation differences between the regimes. And that's a good way to kind of understand the transaction. A very important part of the transaction, and this will depend on the size. Some of the larger transactions, the BMA will reach out relatively quickly with the seeding company regulator and work collaboratively with them on reviewing the transaction. And other transactions, the BMA will review the entire transaction, then reach out to the seeding company regulator and say, do you have any issues with this transaction? Do you fully understand it? But in all cases, the BMA will not approve the transaction until the seeding company regulator is comfortable with it. I can say I see at least one seeding company regulator in the room that I've spoken to over video calls on a transaction. So I think it's a regular occurrence, and the BMA is really willing to engage with any seeding company regulator on any transaction to get them comfortable.
Yeah, I'm happy to take that one, yeah. So this is our final slide, and essentially it's just a conclusion of what we've already gone through. So again, Bermuda, very well established and globally recognized jurisdiction that has been in existence for several decades. Deep resident expertise, maybe a bit of a Silicon Valley effect as far as reinsurance is concerned. And then again, the play here is that we are bringing together a diverse range of investors and their capital, and we're also bringing risk diversification. On the supervisory processes side, quite thorough in execution of our supervisory life cycle, as well as identifying the risks and making sure that they're being addressed as needed. Victor touched on the capital and solvency framework, the fact that it's an economic balance sheet approach, which is different from here where it's more formulaic and prescribed. But we do have various solvency intervention levels, as we demonstrated, similar to the US. And the liquidity risks are tightly controlled and monitored both on the long-term side and the PNC. We realize the need for enhancements, for continual evolution of our regime, and we are very proactive in terms of making sure that we are reviewing what we are doing and making enhancements as needed. And as Webster spoke, we have various areas that we are consulting on, that we are amending and updating on. So with that, we'll pause there and take any questions. Thank you.
Can you hear me? Okay, good. I'll start with the first question. I was hoping you could explain a little bit more with the reference to a consistent economic basis for the measurement of assets. I'm used to amortized cost, and then I'm used to a market consistent basis with fair value with the changes running through the balance sheet. But I'm not familiar with a consistent economic basis and what adjustments you make so that that doesn't have the market volatility reflected.
Yeah, so if you think about the scenario-based approach, where you're projecting out your assets that you own, you're essentially what that works out is you're essentially discounting the liabilities at your asset earned rate. So how do you go about discounting the liability cash flows? Well, you discount the liability cash flows similar to the way the asset cash flows are being discounted in their valuation. So you do get a similar market type valuation of those cash flows as though they were asset cash flows. So that's the consistent basis. So when interest rates move up, the assets and liabilities will move down together, and then vice versa as interest rates move down. So yes, that's how we kind of get the lack of volatility, assuming that the assets and liabilities are well matched. That's kind of key to the whole framework is you need that well matched characteristic of the book for there to be minimal volatility.
Other questions from the audience, or I'll ask another one. All right, so we do have some canned questions, but before we move to those, the new disclosure that's coming this year, where there's going to be more detail on the assets and the liability side, are those assets matched to a specific liability, or can all assets be used for all liabilities, or do you have some breakdown where certain assets are for certain jurisdictions in the reinsurance market, others for others? I guess, how does that work in the Bermuda market?
Yeah, thank you for that question. I think Patience alluded to the fact that our market is mainly a reinsurance market. And of course, the companies that we supervise, they have a number of blocks of businesses that they have. We require companies to manage those blocks as if they're independent. So they have to come up with investment strategies that match the individual blocks that they have. So of course, you might have companies that want to argue about fungibility, but there's a very high bar to actually prove that there's fungibility. So the issue is, as per each block, the company is required to have assets that are appropriate for the liabilities that they have, or the liabilities that form that book. What we intend to achieve with this is, we are hoping that, or the requirement is for companies to disclose all their assets, but at the same time, they should then be able to also disclose all their liabilities, and stakeholders will be able to see even the currencies of the liabilities, the currencies of the assets, the duration, etc. So it should be clear that there is indeed an asset liability matching that is going on, which is what we've been requiring from the companies for years now. So to your question, we do expect there to be that asset liability matching per each block of business.
All right, we probably have time for one more question. Oh, from the back. Would you like the mic?
No. I'm just curious, how many companies or groups are on the scenario-based approach, and as both in number and in percentage of your long-term insurers?
That is a very, very good question. So I think if I'm to predict in terms of the numbers, I would say we have about 40% of our companies being on the scenario-based approach, and this includes companies that may be, like what Patience said earlier, they might be part of the same shareholder group. So it might be maybe, let's say, 5 companies, but they're sort of connected. So we do have quite an appetite for the scenario-based approach, but like what Patience said, what Victor said earlier, the companies have to go through a rigorous approval process for them to be able to adopt that methodology.
Yeah, and I think the point there is that majority of the companies are on a standard approach, because again, it's quite a high bar to use the SPA.
Don't quote me on the percentages, but to Patience's point, I think we still have the majority of our companies are on the standard approach as of now.
Thank you. And again, yeah, and happy to have additional discussions as needed.
Thank you.